Most traders lose because they follow one rule: trade everything they see. Jesse Livermore got wealthy following the opposite. He had two numbers tattooed into his decision-making, 1/4 and 1/5, and he never ever broke them. By the end of this video, you'll understand why a trader worth $100 million in 1929 obsessed over fractions while everyone else chased percentages. The brutal truth cuts deeper than most realize. Your position size doesn't determine your losses. Your refusal to break these two rules does. Think about that for a moment. Every trader who's blown an account believed they were taking calculated risks. They weren't calculating anything. They were gambling with conviction, and conviction is the enemy of wealth. Livermore didn't invent these ratios by accident. They came from years of watching the tape, the live price ticker that told the real story of market psychology. He noticed something most traders miss even today. Winners and losers aren't separated by luck or indicators. They're separated by position sizing discipline. The 1/4 rule was his entry protocol. The 1/5 rule was his exit law. These weren't suggestions. They weren't guidelines. They were law. And this is crucial. Livermore understood that the market doesn't care about your opinion. It cares about your position, size, and your ability to admit when you're wrong. The trader who sizes correctly and exits cleanly survives. The trader who sizes emotionally and holds carelessly dies. It's that simple, and it's that brutal. Here's the amateur's mistake, and you've probably made it. He sees a setup, feels conviction, and buys hard. He's risking 5%, 10%, sometimes 20% of his account on a single trade, because this one's different. He's certain. He's done the analysis. He's watched the charts. He's read the news. And because he's certain, he positions large. Livermore never thought in percentages of his total account. He thought in fractions of his expected move. This is the inversion that separates professionals from the broke. When you think in account, percentages, you're anchoring to fear. Fear of losing. Fear of missing out. Fear that this trade defines your ability. When you think in fractions, of expected moves, you're anchoring to mathematics. One kills you. The other enriches you. Listen to this carefully, because it rewires how you'll approach every future trade. Before Livermore entered a position, he calculated how far the market should move if he was right. That distance, that expected profit target, became his denominator. His entry size, his stop loss, his risk were all fractions of that mathematical target. Think about the elegance of this. He's not asking, how much can I afford to lose? He's asking, what does the market owe me if I'm right? The market's responsibility to him becomes the foundation of his position sizing. If the market moves $4 for every $1 he risks, he enters. If it won't move $4, he doesn't. He walks away. He waits. He does nothing. And that nothing is where his edge lives. The 1/4 formula meant something specific. Only enter when the setup represents a move of at least 4 times your risk. If you're risking $100, you need a realistic target of $400 minimum. Not $300, not $350, $400. The market must owe you 4 times before you risk once. The 1/5 formula meant something equally uncompromising. Never hold a position through a reversal at 1/5 of your target. If the market moved $80 of your $400 target and then reversed, you exited. Full stop. No hope, no averaging down, no second chances. Why? Because these ratios weren't arbitrary. They were his confirmation that the market was following his thesis. If the market wouldn't give him 4-1, he simply didn't trade. If it broke. His 1/5 reversal line, he knew he was wrong, not yet right, just early. The distinction matters. Most traders think I was right on direction just early. Livermore thought, the market rejected my entry, and I trust the market more than my analysis. Most traders read this and think, that seems too strict. Exactly, and that's why they're not wealthy. The amateur is uncomfortable with this level of discipline because discipline demands that he be inactive most of the time. It demands that he watch setups he likes and refuse them. It demands that he sit in cash for months. It demands that he exit winners when emotion says to hold. These demands feel wrong because they violate everything the trading industry teaches you. The industry sells activity. Livermore sold inactivity. The industry sells certainty. Livermore lived in doubt until the market proved him right. The industry sells percentage gains per month. Livermore calculated percentage gains per year, per decade, compound mathematics, not short-term metrics. Here's what separates Livermore from the traders who try to copy him. He actually lived these rules. He didn't write about them during flush times and break them during losses. He didn't follow them when the setups were obvious and ignore them when conviction was high. He followed them always. When the 1/4 rule said no, he heard no. When the 1/5 rule said exit, he exited. And because he did this consistently across thousands of trades over decades, the mathematics rewarded him exponentially. He wasn't smarter than other traders. He wasn't luckier. He was more disciplined. He had rules that worked and the character to execute them when broken rules would have felt more profitable. This is why position size determines your losses, not your stop-loss placement, not your take-profit level. Your position size, because position size is the only variable you control. You can't control whether the market reverses. You can't control whether your analysis is right, but you can control how much you risk. And if you control that through mathematical ratios like the 1/4 rule, you control your maximum loss automatically. Most traders have it backward. They figure out how much they want to win, then reverse engineer a position size. Livermore figured out how much he was willing to lose, then reverse engineered a target. One approach puts you at the mercy of the market. The other puts the market at your mercy. The brutal truth, your refusal to break these two rules determines your losses more than any stop loss ever could. You now know Livermore had two rules. But here's what separates traders who know these rules from traders who live them, understanding why the 1/4 rule exists. And more importantly, why you'll violate it. The difference between knowing and living is the graveyard of trading accounts. 1,000 traders have read about the 1/4 rule. Maybe 50% actually follow it. The gap isn't intelligence. It's not even discipline exactly. It's something deeper. The willingness to feel wrong while being right. The willingness to watch opportunities pass. The willingness to sit in cash while the market moves without you. This is the psychological price of the 1/4 rule, and most traders won't pay it. The 1/4 rule sounds simple. Get 4 times your risk back. But simple isn't easy. Let me show you why. On paper, it's mathematics. In practice, it's a constant negotiation between your conviction and your mathematics. Your conviction will always want to lower the ratio. Your mathematics will never compromise. This is where the real battle happens, not in the market, but in your mind. Imagine Livermore is watching crude oil. There's a breakout from consolidation, classic setup, clean structure, the kind of setup that makes you nod and think, yes, I see it. The momentum is building, the volume is clean. There's a clear resistance level being broken. Everything a trader wants to see is there. But then Livermore checks his math. The risk to the nearest swing low is $2 per barrel. His target, conservatively, is $6 per barrel above entry. That's a 3-to-1 ratio, not 4-to-1. 3-to-1. What does he do? Nothing. He walks away. He doesn't trade it. He closes the chart. He moves to the next market. He does something else. Now imagine you're watching the same setup. You see the same clean structure. You feel the same momentum building. But you do the math differently. You think, well, $6 is conservative. It could go to $7 or $8. And even if it only goes to $5, that's still 2.5-to-1, which is decent. You rationalize. You negotiate with yourself. You lower the threshold. You enter the trade at 3-to-1. The market moves slightly, in your favor, then stalls. It reverses. It hits your stop loss. You're down $200 on a trade that Livermore simply skipped. Meanwhile, Livermore is sitting in cash, feeling no pain, experiencing no emotion, ready for the next setup. Why would a man who made millions by staying sharp refuse a seemingly good trade? Because 3-to-1 isn't 4-to-1. Because amateur traders think this is insane, and that insanity is exactly why they blow accounts while professionals survive. The amateur sees this as leaving money on the table. The professional sees it as protecting capital from a weak setup. The amateur thinks Livermore is too rigid. The professional knows Livermore is too smart. The 1/4 rule isn't about greed, though most traders misunderstand it that way. They think Livermore was greedy, always wanting 4-to-1 or better. Actually, it's the opposite. The 1/4 rule is about signal confirmation. Here's the hidden logic that separates professionals from everyone else. If a market setup is general, you only as strong as you think, the market will give you 4 to -1 or better. If it won't, the setup isn't as strong as your emotion says it is. The market doesn't lie. Your conviction does. The market will tell you the truth if you let it. When a setup offers only 3 to -1, the market is telling you something. It's telling you that the reward isn't proportional to the risk. It's telling you that the move isn't as powerful as it looks. Your job isn't to convince yourself that the setup is still good. Your job is to wait for the market to convince you. Wait for a setup that offers 4-to-1 or better. Then you'll know the market agrees with you. This is the hardest part of Livermore's method for modern traders. We're wired for action. We see a chart. We feel pressure to enter. We fear missing out. Our brains are evolved for hunting, for sprinting, for decisive moments. But trading isn't hunting. Trading is waiting. The 1/4 rule forces you to do something professionals do constantly and amateurs never do: wait. Not passively. Not while anxious. Actively. Intentionally. As a choice. Here's the psychological reframe that changes everything. Waiting is a position. Doing nothing is a trade. When you refuse a 3-to-1 setup in favor of a 4-to-1 setup that arrives next week, you've made a trade. You've shorted your impatience and gone long on patience. You've taken a position against the market's noise and for the market's signal. You've bet that your discipline will pay more than your participation. Most traders would rather lose money actively than make money passively. They'd rather trade a bad setup and lose than sit in cash and feel bored. Livermore would rather sit in cash for months than take a bad entry. He understood that action is the enemy of wealth, not the ally of it. Here's the real number that most traders ignore. Studies of professional traders show that 60 to 70% of their edge comes from position sizing and entry timing, not from picking direction, not from being right about up or down, from sizing correctly and entering at the right moment. The 1/4 rule is that edge. It filters out the noisy trades, the hope trades, the emotion trades. It leaves only the high probability setups. When you study traders who've survived decades, this is what you find. They're not smarter about direction. They're smarter about when to enter and how much to risk. They've systematized the boring stuff and abandoned the exciting stuff. The amateur thinks the 1/4 rule is limiting. He sees it as a cage, a restriction on his trading. The professional knows it's liberating, because every trade that meets the 1/4 rule has statistically higher odds of working. When you only enter 4-to-1 setups, you're not limiting yourself. You're multiplying your edge. You're compounding your probability of success. You're making the market do the work for you instead of you convincing yourself about the market. Think about the practical impact over a year. You see 100 setups. 90% of them are 3-to-1 or worse. Only 10% are 4-to-1 or better. The amateur trades all 100. He wins maybe 45 of them. But his winners average 3-to-1, and his losers average 2.5-to-1. The math is slightly positive, but it's exhausting, it's stressful, and his account grows at 5% per year if he's lucky. Livermore trades only the 10 4-to-1 setups. He wins 6 of them. But his winners average 4-to-1, and his losers average 1-to-1. The math is exponential. His account doubles in a year. The difference isn't the number of trades. It's the quality of the setups he enters. And the 1/4 rule is what filters for quality. This is why Livermore could sit inactive for months, then strike with devastating precision. He wasn't lazy. He was selective. He was waiting. He was watching. And when the market finally offered him a 4-to-1 setup, he knew it was time. He knew the market had confirmed his thesis. He knew the odds were in his favor. That knowledge, that certainty, is what allowed him to size his position with confidence and execute without hesitation. Here's a mystery that most traders never solve. Why do traders blow up in bull markets? Why does a trader make money, then lose it all, and never understand what went wrong? The answer isn't complexity. It's not bad luck. It's not market manipulation. The answer is hiding in the 1/5 rule. And if you don't understand, you'll repeat the pattern forever. You'll make money. You'll feel invincible. You'll break your rules. You'll lose it all. Then you'll be confused about what happened. This cycle destroys more accounts than bad analysis ever could. The 1/5 rule is the antidote to this cycle, and it's the rule most traders refuse to follow because it demands something they're psychologically unprepared to give: profit. Let's say you're long silver. You calculated a 4-to-1 setup perfectly. Your risk is $500. Your target is $2,000 profit. The setup is clean. The entry is precise. The market moves in your direction beautifully. You're up $400. You're 20% of the way to your target. Everything feels right. You're a genius. Your analysis was correct. The market is confirming your thesis. You're making money. You tell yourself this is what trading is supposed to feel like. This is the dream. This is the reason you spent hours analyzing charts. Then the market hesitates. It pulls back slightly. It's not a violent reversal. It's not a gap down. It's just a pullback, a normal breathing of the market. It hasn't hit your stop loss. That's still $500 below entry. But it's no longer making new highs. It's consolidating. It's pausing. It's giving back $80 or $100 of your $400 profit. You tell yourself it's temporary. The market is gat, herring strength for the next leg up. Pullbacks are normal in strong moves. You're not worried. You're confident. Your thesis is intact. You hold. What do the amateurs do? They hold. They add. They tell themselves, it's just a pullback. My thesis is still intact. They're right. Their thesis might still be intact. But Livermore's 1/5 rule doesn't care about your thesis. It doesn't care about your analysis. It doesn't care about your conviction. It cares about market confirmation. And the market just failed to confirm. Here's the principle that separates professionals from the broke. If the market is going to give you $2,000, it shouldn't hesitate and give back $400 or $500 while you're holding. A strong move doesn't do that. A move with genuine momentum doesn't pause and retreat. A strong move keeps moving. It makes new highs. It accelerates. It proves itself. When a strong move pauses and pulls back, it's telling you something. It's telling you the strength wasn't real. It's telling you that the initial thrust was short-lived. It's telling you that what looked like a powerful breakout was actually a trap. A weak move, or a move that's about to reverse, hesitates and pulls back exactly like this. The 1/5 rule states something simple but psychologically devastating. If you've gained 1/5 of your target and the market reverses back through that level, you exit. No negotiation. No, maybe the market will come back. No, I'll give it one more bar. No, let me see how this closes. You exit. Full position. No exceptions. The rule is absolute. The moment the market takes back 1/5 of your profit from that pivot point, you're done. You're out. You're flat. You've exited the trade. Why is this rule so psychologically brutal? Because it forces you out of a trade that's still profitable. You're not cutting a loss. You're cutting a winner. You're exiting with money in your account. Why? Or leaving the table while you're ahead. And the human brain hates that. The human brain wants to let winners run. The human brain wants to see how far the move can go. The human brain wants to extract every penny. But Livermore's brain worked differently. He understood that protecting profit was more important than chasing profit. The amateur trader sees the plus $400 profit and can't fathom leaving it. He thinks he'll re-enter if the market proves itself again. He never does, because that's not how markets work. Once you're out of a trade and the market reverses, getting back in at a higher price means accepting worse odds. It means your risk-reward ratio is now worse than 4-to-1, so he never re-enters. Instead, he watches. He watches the market pull back further. His $400 profit becomes a $300 profit, then a $200 profit. He's now frustrated. He's now questioning his analysis. The reversal accelerates. His $400 profit becomes a $100 profit. Now he's questioning everything. His discipline disappears. He's holding a trade that's moving against him, and his stop loss is $500 away. Surely it will come back. Surely the thesis is still intact. He holds. The market keeps falling. Now he's at break-even. His $400 profit is gone. He's at the exact price he entered. He's furious. He should have taken the profit. He should have exited. But he holds, thinking the market will prove him right again. It doesn't. He hits his stop loss. He's now down $500. The original trade, the beautiful 4-to-1 setup, has become a loss. But it gets worse, because this pattern repeats. He's now demoralized. He's now desperate to make back the loss. He takes a bad setup. He loses another $400. He's down $900 total. He takes another bad setup to make it back. He loses $600. He's now down $1,500 total. The $2,000 trade that could have been a 20% portfolio profit on a $10,000 account is now a 15% portfolio. Loss. That's a $3,500 swing from one broken 1/5 rule. Livermore lived by this rule because he understood something traders still refuse to accept. Being right about direction and being profitable are different things. You can be right about direction and still lose money. You can call the market correctly and still blow your account. A trade can move in your favor and still teach you that your entry was premature, or the setup was weaker than you thought. The 1/5 rule listens to what the market is actually telling you, not what you want it to tell you. The market is saying, I'm not as strong as you calculated. Exit now while you have profit instead of later when you have pain. This isn't the market rejecting your analysis. This is the market saying your analysis overestimated the strength, and that's critical information. That's the market confirming that your thesis was flawed. The professionals who survived decades use versions of this rule constantly. They call it different names: scaling out at reversals, trailing stops, profit taking on weakness. But the DNA is identical to Livermore's 1/5 formula. They don't hold through pullbacks at 1/5 levels. They exit and move on. They know that patience entering is worthless if ambition poisons the exit. You can have the best entry in the world, but if you exit poorly, the trade is lost. Livermore knew this. He had the discipline to enter when the math said enter. He had even greater discipline to exit when the market said exit. The 1/5 rule is ruthless because it forces exits from profitable trades, violating the trader's most primal instinct to let winners run. But this is exactly where discipline proves its worth. By exiting on the first 1/5 reversal, the trader preserves capital, protects profit, and avoids the catastrophic pattern of turning small wins into huge losses through stubborn holding. This rule isn't hiding your profits. It's protecting your survival. You've learned the entry rule. You've learned the exit rule. Now here's the trap that kills traders who know both but don't connect them, treating them as separate systems instead of one unified law. This is where thousands of traders fail. They read about the 1/4 rule and implement it. They read about the 1/5 rule and implement it. But they implement them as two different strategies running on different logic. That's the mistake. Livermore didn't use 1/4 and 1/5 as independent tools. He used them as a confirmation system, and this is where the real edge lives. The edge isn't in knowing the rules. The edge is in understanding how they talk to each other, how they validate each other, how they create a feedback loop that forces you to trade only the setups the market actually wants to move. Most traders think like this: I enter when I find a 4-to-1 setup. Then I hold until my target or my stop loss. Clean logic, wrong outcome. That's because they're not thinking in Livermore's framework. They're thinking in a linear framework. Enter here, hold, exit there. But Livermore's framework was circular. It was a loop. The entry rule and exit rule fed into each other. They validated each other. They created a dynamic system where the market was constantly voting on whether the trade was valid. Here's how Livermore's system actually worked, and this is crucial to understand. The 1/4 rule filtered entries. Only trades with 4-to-1 or better passed the filter. But then, and this is critical, the 1/5 rule policed the trade in real time. It wasn't a passive hold until target system. It was an active confirmation mechanism that asked the market a constant question. Is the market actually performing as the 4-to-1 setup promised? That question matters more than anything else, because the market's answer determines whether you hold or exit. Think of it this way. You enter a stock on a 4-to-1 setup. You've done the analysis. The setup is clean. The entry is precise. The setup said, if I'm right, this stock should move $4 per share before it reverses. You've put your capital at risk based on that promise. The stock moves in your favor. You're up 50 cents. Good. The stock moves another 50 cents. You're up $1. Better. But then the stock hesitates. It moves 20 cents and then reverses hard. It takes back your dollar profit and then some. It moves back through your 1/5 break-even level. What does that tell you? It tells you that the market never believed your 4-to-1 thesis. The setup looked right on the chart. The analysis was correct. But the market rejected it. The market said no. This distinction is everything. Your analysis doesn't determine whether the trade is valid. The market's response determines whether the trade is valid. If the market was going to move $4 per share, it wouldn't stall at $1 and reverse. It wouldn't give back its gains. A move with real strength doesn't do that. A move with genuine momentum doesn't hesitate. The market's hesitation is the market's veto, and the 1/5 rule forces you to obey that veto. A trader without the 1/5 rule would hold through this reversal. He'd rationalize it. He'd say, this is just a pullback. The thesis is still intact. I'll give it another bar or two. He'd hope the market comes back. It doesn't. He'd rationalize deeper. He'd say, maybe the reversal is just profit-taking. Smart money is shaking out weak hands. I'm not weak, I'm holding. The market keeps falling. He's now at break-even. He's now questioning his analysis. He's now holding a losing trade, and his conviction has completely evaporated. He's no longer holding because he believes in the thesis. He's holding because he's afraid to admit he was wrong. He's holding because taking a loss feels like failure. He holds through his stop loss. He's now down multiple points. The 4-to-1 setup that should have made him wealthy has made him poor. He's blown this trade. A trader with both rules, the 1/4 rule and the 1/5 rule working together, exits immediately with a small loss the moment the market reverses through the 1/5 level. He doesn't rationalize, he doesn't hope, he doesn't hold, he exits, he preserves capital. Then he waits for the next 4-to-1 setup that the market actually confirms by moving in his direction without hesitation or reversal. Here's the nested logic that creates Livermore's edge. The 1/4 rule is your filter. It says, only enter setups that offer 4-to-1 or better. The 1/5 rule is your veto. It says, if the market reverses at 1/5 of the target, reject the setup even if it looked good. Together they create a feedback loop that forces you to trade only setups that the market actively confirms, not passively allows. The market's silence becomes rejection. The market's hesitation becomes a veto. You're not forcing trades. You're allowing the market to select which trades matter. This is why Livermore's win rate on individual trades wasn't extraordinary, maybe 55 to 60%. He wasn't trying to be right on every trade. He was trying to be profitable on the aggregate, but his profit factor, the ratio of average winners to average losers, was massive. He won less often, but when he won big. When he lost small. A 55% win rate at 4-to-1 payoff is exponentially more profitable than a 70% win rate at 1-to-1 payoff. The combination of these two rules is what created that asymmetry. The math became unstoppable. Most traders chase win rates. They try to be right 70%, 80% of the time. That's backward thinking. That's amateur thinking. Livermore chased profit asymmetry, bigger winners than losers. He didn't care if he was right 55% of the time as long as his winners were 4 times bigger than his losers. The 1/4 rule ensures targets are 4 times the risk. The 1/4 rule creates that asymmetry on the upside. The 1/5 rule ensures losers are cut fast. The 1/5 rule protects that asymmetry from being destroyed. Win 55% of the time at 4-to-1 payoff, cut 45% of the time with minimal loss, and you're exponentially wealthy. The math is irresistible. Here's the dangerous inversion that destroys so-called good traders. A trader who follows the 1/4 rule but ignores the 1/5 rule often gets destroyed. He only takes good entries. His discipline on entry is flawless. He refuses bad setups. He's patient. He waits for 4-to-1 or better, but then he holds through the invalidation carelessly. The market reverses at the 1/5 level, and he ignores it. He tells himself the thesis is still valid. He holds. He refuses small losses because they hurt his ego. He holds longer. He turns small losses into huge ones. His discipline on entry is completely undermined by his recklessness on exit. He's a good trader until he blows his account. This is how good traders disappear from the market. This is how disciplined traders become cautionary tales. The rules must work together or they don't work at all. The 1/4 rule and 1/5 rule form an integrated system, not two independent tools. Think of them as a dialogue between you and the market. You say, I'll only enter setups that offer 4-to-1. The market responds with movement or lack thereof. If the market moves without hesitation, the dialogue continues. If the market hesitates and reverses at the 1/5 level, the market says no. You listen. You exit. This dialogue repeats across dozens and hundreds of trades. Together, they create a feedback loop, enter only promising setups, but exit immediately if the market refuses to perform. This system produces an asymmetrical win rate, maybe 55 to 60 winners, with massive profit factors. A trader following only the 1/4 rule but ignoring the 1/5 rule destroys himself by entering good setups but holding through invalidation, turning small losses into catastrophic ones. The rules are interdependent. The 1/4 rule is the filter. The 1/5 rule is the veto. Separated, they fail. Separated, they create false confidence. Separated, they leave you vulnerable to emotional trading. Together, they create Livermore's edge, discipline on entry, ruthlessness on exit, and markets that confirm the thesis through their own price action, not the trader's conviction. That edge compounds across time. You now understand the mathematics. You understand the mechanics. The 1/4 rule filters entries. The 1/5 rule polices exits. Together they create an integrated system. You've read this far, and intellectually you understand how it works. But let me tell you something brutal. Knowing these rules and living them are entirely different animals. They exist in different dimensions. Knowing is cognitive. Living is psychological. Living is identity. Living is character. And Livermore knew this distinction intimately. He'd seen countless traders who understood the math but couldn't execute the discipline. Most of his writings weren't about the rules themselves. They were about why traders break them, why they know the rule is correct but violate it anyway, why they sabotage their own system, why they transform winning trades into losing trades through a single moment of weakness. Here's the scenario that destroys most traders, and if you've traded for more than a few months, you've lived it. You've been sitting in cash for 3 months, following the 1/4 rule perfectly. You're disciplined, you're patient, you're waiting for a 4-to-1 setup that meets your criteria. You've turned down 19 setups because they didn't offer 4-to-1 or better. Your account is calm. Your wins have been clean, your losers have been small, you're building confidence in your system. Then finally, the setup arrives. A textbook 4-to-1 setup. Everything aligns. You enter the trade with conviction. This is the one you've been waiting for. The market moves in your direction beautifully. You're up $300. You're up $500. You're approaching your 1/5 profit level. Everything is working. You're validated. 3 months of patience have paid off. You're a genius. Your analysis is flawless. The market is confirming your thesis. Then the market hesitates. It moves 1/5 of your target and stalls. The 1/5 rule says exit. Your rules, the ones you've been so disciplined about following, are now screaming at you to exit. Exit now. Exit here. Exit with profit. The rules are clear. But something in your brain screams, no. You waited 3 months. You earned this. The setup is still valid. The market is just breathing. That voice is seductive. That voice sounds logical. That voice sounds like wisdom. You hold. You're fighting the urge to exit, and you're losing the fight. The market pulls back further. It takes back your profit. You're now at break-even on the trade. The 1/5 rule is screaming even louder, exit now. But you hold. You rationalize. You tell yourself that the setup is still intact. The market will prove itself again. You just need to be patient. You hold. Livermore called this the pivotal point. Not the pivot in the market, the pivot in your psychology. Every trade has a pivotal point. Every trade has a moment where the market is testing whether you actually believe your own rules or whether you're just pretending, whether you have discipline or just the appearance of discipline. That moment, when the 1/5 reversal happens, is the test. It's the market asking, do you mean what you said? Most traders fail it. They talk about discipline in calm markets. They talk, about following rules when money isn't on the line. But when the pivotal point arrives, when the rules demand action that feels wrong, most traders fold. Why? Because breaking the rules feels logical in the moment. It feels like you're honoring the original thesis. Your analysis was correct. The market is still moving in the direction you predicted. The problem is just timing. You're early, not wrong. It feels like you'd be abandoning a valid setup if you exited. It feels like you're surrendering. What it actually is, fear of being wrong, plus attachment to the entry, plus conviction override, plus math avoidance. That cocktail kills accounts. That combination of emotions and rationalizations destroys traders who have everything else right. They have good entries, they have correct analysis, they have discipline on most days. But on the pivotal point, they crack, they break, they compound their mistake. Livermore's solution wasn't a better formula. It wasn't more precise math. It wasn't a tighter stop loss or a different indicator. It was something much deeper and much more powerful. It was a different identity. He didn't think of himself as a trader trying to extract profit from markets. He didn't identity as a profit seeker. He didn't identify as an analyst trying to be right about direction. He thought of himself as a rule follower who happens to trade. The rule came first. The profit came second. This inversion is why he could execute them ruthlessly. This inversion is what separated him from every other trader who knew the rules but couldn't follow them. Think about the power of that shift. If you identify as a profit seeker, the pivotal point tests you. The market gives back profit, and your identity is threatened. You hold because holding preserves your identity as someone who can make money. If you identify as a rule follower, the pivotal point is simple. The rule S. I is exit. Your identity is to follow the rule. You exit. The profit is secondary. The rule is primary. This psychological reorientation changes everything about how you respond to market stress. Here's the operative maxim that captures the essence of this identity shift. Profits are made by sitting, not trading. This doesn't mean doing nothing. It doesn't mean passive inactivity. It means doing nothing when there's nothing to do. It means sitting in cash when setups don't meet 4-to-1. It means exiting when the 1/5 rule says exit, even though exiting feels like surrender. Even though exiting feels like you're leaving money on the table. Even though exiting violates everything your conviction is telling you. Because Livermore understood that the profit came from the compound effect of small, disciplined decisions over years, not from any single trade. One trade doesn't matter. 100 trades matter. 1,000 trades matter. The system matters. The amateur asks a question that seems logical. What if I exit on the 1/5 reversal and the market goes to my full target? It's a great question. It's the question that destroys discipline. It's the question that makes traders second-guess the 1/5 rule. And the answer is simple. It might. The market might go to your full target. You might miss out on that gain. But Livermore never cared about that. He never cared about individual missed gains. He cared about the average outcome of 100 trades, not the outcome of any single trade. If the 1/5 rule cost him on 5% of his trades, trades where he exited early and the market moved to the full target, but saved him from catastrophe on 15% of his trades, trades where exiting early prevented massive losses, the math is in his favor overwhelmingly. He doesn't need to be right about individual trades. He needs the rules to be right about the system. And the system, lived across dozens and hundreds of trades, is mathematically unstoppable. This is why the psychological architecture matters more than the numbers. You can memorize 1/4 and 1/5. You can write them on your wall. You can recite them before trading. But when the market tests you, and it will because every market creates pivotal points, your identity will determine whether you hold or exit. Are you a trader or are you a rule follower? Are you profit-seeking or are you process-oriented? Livermore chose identity first, profit followed. He chose to be a rule follower before he chose to be profitable. And that choice, lived repeatedly across years of trading, created a fortune. The hardest part of this chapter is admitting something about yourself. When you face the pivotal point, you will want to break the rules. Your conviction will be strong. Your analysis will tell you the setup is still valid. Your fear of being wrong will be intense. Your desire to prove yourself right will be overwhelming. And in that moment, your identity will be tested. If your identity is tied to being right, you'll break the rules. If your identity is tied to following rules, you'll obey them. Build your identity now before the pivotal point arrives, because when it arrives, there won't be time for philosophy. There will only be time for character. We opened this video with a brutal truth. Most traders lose because they trade everything they see. They see movement, they see opportunity, they see a chart forming a pattern, and they trade. They're addicted to action. They're addicted to the feeling of being in the market. They're addicted to the possibility that this trade, this one right here, will be the big winner. Livermore got wealthy by trading almost nothing, by sitting in cash for months, by watching setups he liked and refusing them, by doing less, not more, by being inactive, not active. And when he ID trade, when a setup finally met his criteria, he traded that nothing with mathematical precision. He entered at exactly the right size. He exited at exactly the right moment. He let the rules determine everything. Now we close that loop that opened at the beginning of this video, and I'll give you the 3 decisions that separate intention from execution. Knowing about these rules and actually living them are separated by a chasm. Most traders will watch this video, nod along, think, yes, that makes sense, and then tomorrow they'll see a 3-to-1 setup and trade it anyway. They'll tell themselves it's close enough. They'll rationalize, they'll break the rules, and their accounts will suffer for it. You have a choice to make right now. Are you going to be a trader who knows about these rules, or are you going to be a trader who lives by them? You now understand the rules intellectually. You've heard the logic, you've seen the numbers. You know why the 1/4 rule makes sense. You know why the 1/5 rule saves accounts. You can explain both rules to someone else. But intellectual understanding is the easiest part. Execution is where the real work begins. Here's what separates traders who watch videos about Livermore and traders who become Livermore-style traders: willingness to start small and live by the rules before profit arrives. Not after, not once you're profitable, before, while you're still learning, while you're still building the habit, while you're still developing the character to execute under pressure. That willingness to suffer through a period of discipline and inactivity before the profits arrive is what separates professionals from people who watch educational content and think they've learned something. Decision 1, commit to the 1/4 rule. Write it down right now. Don't think about it later. Write it down. Print it out. Tape it to your monitor. Put it your phone as a reminder. For the next 30 days, record every single setup you don't trade because it didn't meet 4-to-1 or better. Keep a notebook. Write down the setup. Write down why it was attractive. Write down the actual risk-reward ratio. Write down why it didn't meet the threshold. Don't feel bad about these rejected setups. Don't feel like you're missing out. These aren't losses. These are your wins. These are your discipline. These are the trades that are building your character. The trader who turns down 23-to-1 setups in favor of 3-4-to-1 setups has made 20 winning trades. He just made them by not trading. He made them by having the discipline to say no. He made them by trusting the system. That discipline, that refusal, that no thank you. That's where the edge lives. That's where the wealth is built. After 30 days of this exercise, something shifts in your psychology. You stop thinking of the market as a place where you need to participate. You start thinking of the market as a place where opportunities will eventually arrive if you're patient. You stop feeling desperate to trade. You stop feeling like you're missing out. You start feeling like you're guarding your capital. You start feeling like you're a professional. Because professionals don't trade everything. Professionals wait. Professionals are selective. Professionals turn down most opportunities. And that selectivity is what makes them wealthy. Decision 2. Make the 1/5 rule non-negotiable. This is harder than decision 1 because this rule requires you to exit trades that are making money. Write it down. Put it on your monitor. When the market reverses 1/5 of your target, you exit. Full stop. No discussion. Not maybe I'll watch for another bar. Not let me see how this close looks. Not I'll give it one more hour. You exit. You close the position. You move on. And here's the critical part. When you exit, don't re-enter that trade. Don't try to catch it again at a higher price. Don't wait for confirmation and then jump back in. You've received market feedback. The feedback was, this move isn't as strong as you calculated. Accept that feedback. The market is talking to you, and you need to listen. The market is saying, this isn't going where you thought. Exit now. Listen to the market more than you listen to your conviction. The psychological breakthrough happens when you celebrate, exiting a trade at plus $200 profit instead of regretting it, when you feel victory instead of loss, when you recognize that you've done something most traders can't do. You've taken a small profit and protected your capital. You're not leaving money on the table. The money on the table belongs to the market, not to you. You took your piece. You left the rest. You're not greedy. You're practical. You're professional. You're alive to trade another day. That mindset shift from regret to celebration is the moment your trading changes. That's the moment you become dangerous to the market because you've aligned yourself with its reality instead of fighting it. Decision 3. Track your system, not your trades. This is the most important decision because it rewires how you measure success. Stop counting wins and losses. Stop tracking your win rate. Stop obsessing over your profit factor on individual trades. Start measuring something else entirely. Start tracking, did I follow the 1/4 rule on entry? Did I follow the 1/5 rule on exit? If the answer is yes to both questions, the trade was a professional trade, regardless of outcome. If you entered a 4-to-1 setup and exited on the 1/5 reversal, you made a professional trade. Period. It doesn't matter if you lost money on that trade. It doesn't matter if you could have made more money by holding longer. You have followed the system. You executed the rules. You did your job. Your job isn't to win every trade. Your job is to follow the system. The market's job is to reward that system over time. If the answer is no, if you entered a 3-to-1 setup or exited for emotional reasons instead of following the 1/5 rule, then you traded emotionally. The outcome is irrelevant to your growth. A winning emotional trade teaches you nothing. A losing emotional trade teaches you to break your rules more. But a winning professional trade and a losing professional trade teach you the same thing. The system works when you execute it. They both teach you to trust the process. Here's the hidden progression that Livermore discovered over decades of trading and losing and rebuilding traders who focus on following rules, not on winning individual trades. Eventually win far more trades. Not because they're smarter, not because they pick better setups, but because rule following removes emotion, which removes desperation, which removes the need to trade, which removes poor decision making. When you stop needing to win every trade, you stop trading bad setups. When you stop needing immediate profits, you stop holding through reversals. When you stop needing to be right, you start listening to the market. And traders who listen to the market make better decisions. The maxim for this final chapter captures everything. The goal is not to make money. The goal is to follow the process. Money is what follows process. This sounds simple when you read it. It is simple. But it's also devastatingly powerful, because it inverts everything. It says that profit isn't the goal. Profit is the consequence. The goal is executing the system. The goal is following the rules. The goal is becoming the kind of trader who can enter when the math says enter and exit, when the market says exit. Money follows that character. Money follows that discipline. Money follows that system. Livermore lived until 1940, and his last writings focused on this inversion. He'd made and lost fortunes multiple times. He'd experienced the full spectrum of trading outcomes. He'd known bankruptcy. He'd known extraordinary wealth. But every single fortune, every single time he built money, he built it the same way. 1/4 entry rule, 1/5 exit rule, ruthless discipline, patience measured in months, and identity aligned with process over outcome. He never deviated. He never got fancy. He never chased. He followed the system. You're not going to become wealthy on the next trade. You're not going to become wealthy on the next 10 trades. You're going to become wealthy over the next 1,000 trades. Each one lived according to a rule system that removes emotion and forces you to wait for markets that matter. That's the timeline you need to commit to. Not days, not weeks, not even months, years. Patience measured in years. That's the price of Livermore's edge. Here's your final assignment, and this is the only assignment that matters. Before your next trade, ask yourself 3 questions. Does this setup offer 4-to-1 or better? If no, close the chart. Close it now. Don't watch it. Don't hope it develops into 4-to-1. Close it. Move to another market. If I enter and the market reverses 1/5 of my target, will I exit without hesitation? If the answer is no, if you know you'll rationalize and hold, then don't enter. The trade is telling you something. Listen, your own doubt is the market's way of protecting you. Can I enter this at a small size? If the answer to all 3 questions is yes, then enter. Size doesn't matter. The size is irrelevant. Process matters. Process is everything. And process, lived across dozens and hundreds of trades over months and years, is what built Jesse Livermore's legacy. And it's what will build why. Ours, the next lesson, the one that deepens this foundation, is on pyramiding into strength and the art of scaling positions. But that's only for traders who've mastered the 1/4 and 1/5 rules. Master these rules first, live them, execute them, make them part of your identity. Then, only then, you can add complexity. Because complexity without foundation is just sophisticated gambling. Foundation without complexity is wealth. Master the foundation. The mathematics will do the rest.